Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. Here's your daily technical analysis of foreign exchange markets. We'll start with the euro against the dollar. A second bearish black crow yesterday as the market dipped down and finally reached target X1 in the 96.10 area. This was the secondary harder to reach target for the late March to early July imperfect descending triangle. Overall, until last week, you could have argued that the market was still following the big old January to May 2021 bearish Andrews pitchfork. This venerable pitchfork had shown the way lower for so long, despite getting breached and broken, mending itself, re-breached, broken, remending itself. However, the key reversal down on Tuesday last week set events in motion that broke down through the bottom of this pitchfork and established a newer pattern. This pattern is the June to August bearish shift pitchfork, with the market at the moment in between the lower time below, currently at 94.64, and the middle time above, currently at 97.62. At the moment, the market is in a widespread but significant area of congestion, split into three groups. The first group is the 96.61 to 97.72 area, the second is the 96.20 area, and the third is the 95.65 to 95.23 area. Now below this last area we have some free air until the 94.28 area. Now so far today, a small pullback up over the 96.20 congestion and looking like a reactionary indecisive spinning top right now. You can possibly see it as far as a small bullish harami if you wanted to. Cable, aka sterling against the US dollar. A second bearish black Mariposa yesterday and a second close below the June to early August bearish Andrews pitchfork that had run this market for the last couple of months. Since the savage drop yesterday below the previous all-time low of March 1985 at 105.22, the market allegedly dropped as far as 103.27. However, I only have 103.82 as the low on my daily chart. There's apparently a steward's inquiry going on as to whether at about 1 a.m. London time on Monday morning there was a small flash crash. Apparently spreads went out initially to 10 ticks and then to 50 ticks. If that is the case, then one has to say the BOE, Bank of England, the old lady, was once again asleep at the wheel. And this time it was a move that could have been easily foreseen in advance, given what happened late in the previous week. Media's making big news on this being a new all-time low, that the March 1985 low at 105.22 was the previous all-time low. Well, I can see their point, but I was there at the time and I do recall that there was an out-of-hours low on a Saturday morning session, either in Bahrain at that time, which was a market, or Japan at that time, that allegedly traded at parity. I can't confirm this beyond my own recollection, as time and sales then were, let's say, were not what they are now. Anyway, above the market we have congestion at 108.83 and then between 111 even and 113, dating from January 1985. Meanwhile, further down we have support at 106.38, 105.43 to 105.22. Now so far today, well, an interesting pullback up, looking like a possible bullish harami right now, even a possible bullish double. Euro sterling. A second bullish white soldier yesterday, this one with a very long tongue and tail, and looking like an oversized indecisive spinning top without actually being an oversized indecisive spinning top. The market punched up and through the upper time, currently at 90.62 of the April to August bullish Andrews pitchfork, as well as the January 2021 high at 90.86 and the December 2020 high at 92.18. However, this was a breach rather than a break of the upper time, and the market closed back below the upper time and above the middle time, currently at 87.93, seemingly mending itself, well, at least for now. What has become, well, even more obvious than before, is that whilst we do have resistance above, these are not concentrated but spread out over quite a bit. Two other things to note. Firstly, the very recent move higher ties in with a golden cross of the rising short-medium moving average, currently 85.45, moving up over the rising medium moving average, currently also 85.45. This all happened over this past weekend. Secondly, we had a bullish bow tie formation of the short moving average, currently 87.32, short medium moving average currently at 85.51, and the medium moving average currently 85.44 on the 2nd of September. If anything telegraphed a possible break higher, then it was this bow tie formation at the beginning of September. As you would normally expect to see volatility and a possible rise between 15 to 20 sessions after the crossover. That would have made it between the 23rd and 29th of September, which fits in with what has actually happened. Now, so far today, a reactionary move lower after recent rises and looking right now like a possible bearish engulfing pattern. Below, we have the breached upper bull channel line currently at 88.63, the September-based bull channel, broken bull channel, and the 50% Fibonacci line of the March 2020 to March 22 move at 88.51. US dollar against the Indian rupee. A gapping higher bullish opening white Marubozu yesterday made fresh new highs. It was also the fourth bullish white soldier. Now, I have left on the daily chart a possible target above, target X3 in the 82.04 area. This is from some while ago. This is the possible target for the May to day action being a possible bullish halfway hesitation. It's not a good pattern, or rather the first part was a good pattern and the second part ended up being a complete casserole, but it still stands there. There are two final things to look I'd like to discuss. Firstly, the market is now peaking and above the upper time, currently 81.42 of the early June to early August bullish shift pitchfork. This needs to be watched closely. Secondly, since last week we've had two gaps. Now, given the gaps usually occur in threes, the breakaway, the mid-range and the exhaustion gap, then it would not be worth looking out for any exhaustion gaps. Well, it would be worth looking out for any exhaustion gaps that may happen and that might occur. Now, so far today, an interesting parallel to yesterday's action, and no filling in, nothing of the filling in of that 0.1 gap left over so far between 27 and 28. Right now, it is looking like a possible bullish matching, possibly even day two in a 2-day descending hawk pattern. US dollar against the Brazilian real. A second consecutive and somewhat rare bullish opening long white Marubozu yesterday. It is quite spooky to see yesterday being almost a complete copy, if higher, of last Friday's action. This action was a confirmation of the move higher from the congestion below formed through most of August and September, between about 5.05 and 3/4 and 5.25 even, as well as a delayed response, if you can call it that, to the mid-August bow tie formation. Interestingly, the peak of yesterday was just short of the rising middle time, currently at 542.81, and that's of the late May to late August bullish Andrews pitchfork. It'll be interesting to see how this market performs today. Now, looking ahead and higher, we still have a potential topside primary target X in the 568.85 area, and a harder to reach target X1 off the top of the daily chart in the 584 area. Both are from the March to June ugly double bottom pattern. These looked so out of reach, but recently have moved more into the mainstream. US dollar against the Mexican peso. A second bullish long white Marubozu yesterday. Last Friday's action was the pulled trigger that led to yesterday's action. You see, last Friday saw the market gather ammunition from its base, the core of the congestion formed over August and September between 1990 and 2020, and included the Middle time currently at 1991.63 of the March to July bearish shift pitchfork. And it took all of that and finally close on the short medium moving average, currently at 2017.13. The market had punched up and through 3 out of 4 of the moving averages, reaching and testing the one remaining, the slowly declining long moving average, currently at 20.25 and a quarter, plus pierced the upper time, currently 20.18 and a quarter, of the March to July bearish Andrews pitchfork. Now, yesterday the market utilized the congestion around the short medium moving average and the long moving average and the upper time to break higher in a fairly free zone out of this congestion that had started to look like a jail, and to end up just short of the lesser Fibonacci line at 20.4566. This action made the first close above all of the moving averages since early August. Yet I have a caution, and my caution is based on what happened the last time the market punched up over the long moving average back in early August. Back then, it was a 2-day wonder that formed a pipe top and reasserted the bearish incentive by the end of that week. The difference this time is that the moving averages are even more evenly spread out. Amongst the congestion below, and there is this congestion below, something that wasn't there last time. Well, so far today, a slightly higher open, but then a test down straight to the support of the long moving average before a turn back up, though not as high as the open, and looking like it might be a hanging man pattern for today. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.